Equity market update. After 2 consecutive months of gains, the Nifty and S&P BSE Sensex closed almost flat in January 2024. Mid-cap and small-cap index outperformed the large-cap benchmarks. Key events and factors included escalating tensions in the Middle East, diminishing likelihood of a US recession, the NSO projecting India's GDP growth for FY24 at 7.3%, surpassing consensus expectations, among others. Sector indices exhibited a mixed performance, with strong gains in oil and gas, power, healthcare, and auto, while banking, FMCG, and metal underperformed. Global market performance was varied, with month-on-month gains seen in Japanese, US, and European indices, while Chinese and Korean markets underperformed. FPI sold equities worth USD 3.1 billion in January 2024, as opposed to net purchase of USD 7.9 billion in December 2023. FPIs have bought equities worth USD 20.8 billion in 10 MFY24. DIIs, on the other hand, bought net equity worth USD 3.3 billion in January 2024, December 2023, USD 1.6 billion, and have cumulatively bought equity worth USD 15.5 billion in 10 MFY24. Flows to mutual funds increased to approximately INR 24,800 crore in December 2023 compared to approximately INR 21,700 crores a month before. Cumulatively, MF flows in equity-oriented schemes in 9 MFY24 stood at approximately INR 158,000 crores. Of the Q2 FY24 results declared so far, earnings of banks, IT, cement and pharma sectors were better than expected, while that of NBFCs, metals, oil and gas, capital goods, consumer staples and durables were in line with expectations. Results of logistics and chemicals were lower than expected. Outlook. As on January 31, 2024, Nifty 50 was trading at approximately 18 times FY26 E price-to-earnings multiple. Further, market cap to GDP stood over 100% based on CY25 GDP estimates, and the gap between 10-year GSEC yield and 1-year forward Nifty 50 earnings yield remains at elevated level. In general, current valuation indicators are at premium to their historical averages. However, one should view these valuations in the context of structurally attractive nominal GDP growth, a healthy corporate earnings outlook, and robust delevered corporate and banking balance sheets. Except for private banks, valuations for most major sectors are higher than long-term averages. The sharp, broad-based rally in the current financial year has resulted in small-cap and mid-cap indices significantly outperforming, and they now trade at a noteworthy premium to their long-term average valuation. Given the aggregate valuation being higher than historical average, the importance of stock selection increases even more. We maintain a positive outlook on equities for the medium to long term, driven by the structurally robust domestic growth outlook, healthy corporate profitability, and supportive pro-growth policies. However, near-term risks include a significant global growth slowdown, heightened geopolitical tensions, and a resurgence of inflation either globally or domestically. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.